the best thing that you guys do is your banter on LinkedIn. Publicly, just go. When you invest, the shitty deals go bankrupt first. It is fucking hard to make a business go.
To make sure we don't screw it up.
There is 1,000 ways that we will fuck up a deal, and there's maybe one or two that's going to hit right. Yeah, is the founder putting any money in the deal? Is the founder taking a salary? To go make this happen, you have to be 100% plus invested in this.
Hey everybody, welcome to the Cheat Code. Hello and welcome back to the Cheat Code and Friends podcast, joined as always by Justin Gray and Sean Kester. Today's illustrious guest, who would be the friend, Craig Coppola. What do we call you these days, Craig? Founder, Lee & Associates, Arizona, investor, LP, and in Revenue Capital, all those things. So, Craig, we'll get right into it because you told us we have too long intros before the podcast started. We're gonna get it rocking and rolling here. You've been investing privately, 25 years, millions of dollars into startups, and B2B SaaS and otherwise. How did you fall into that world of craziness?
You know, my business has been really an interesting one. For what I do for a living is represent tenants for commercial office space and have done that for over 40 years. But I meet CEOs of companies. And 25 years ago, I met a couple CEOs and started doing some side investing just as a lark. And I loved it. I loved it, and I hated it. I mean, it's a love-hate deal. And in fact, Josh, yeah, right. You guys, it's the greatest thing and it's the worst thing. And what I found was, this is the worst kind of business because when you invest, the shitty deals go bankrupt first. And so you look like an idiot for the first 3 or 4 years. I looked like an idiot. And then I had one that kind of hit and I was like, oh, this is kind of cool. And so I just kept doing it. So that was the background of this. And then I started thinking, I need to have more so I can have more exits.
Well, it's kind of atypical though. We have a fair amount of folks in our portfolio, since you mentioned in Revenue Capital, that are in commercial real estate. And we find that the education cycle is somewhat significant, right? It's not what you guys do every day. So how did you make that leap, right? Into this is an operating business, kind of, it's early, it may be an idea. And then how did that thinking evolve over time? Because you mentioned I met a CEO, they had this thing, got it going, but from there to now, what are some of the different things that you've learned over time?
Well, I've always been, and one of the things is, what do you invest in? I've always been a jockey investor. I've always been a founder investor. And so I have found, and nothing's changed me from that. Founders are my number one thing that I look for. And I was meeting, and you can tell there's some people that get it and some that don't. But I do think that what I did initially, because I'm in the business, I have a nice real estate portfolio, and my best deals have been really commercial real estate. So if I were strictly just saying, hey, I'm going to continue to invest, I would probably just buy real estate on my own account. But I just enjoyed this piece more, and I enjoy the risk capital of it, but I enjoy the ups and downs of it. And so trying to watch people as they kind of figure out what the next venture is. And so we started our company, Justin, you had a couple exits. Josh, you guys, obviously, when you sold your last venture and started this, we started Lee & Associates Arizona in 1991. So I really never thought of myself as an entrepreneur, but I owned my own company from 1991. I was 30 years old.
It wasn't called that back then.
That's right. You were just a businessman, right?
That's right. You're a businessman who probably had a organization that was looked on as very successful, certainly in the early stages. Being an entrepreneur was not cool when we became entrepreneurs, I think.
Well, and when we started the business, to your point, back then, we didn't have any capital to kind of wait 3-5 years before we made a dime. We were like, how are we going to make this? How are we going to make a profit in the next 60 days. And that was the big risk. I mean, my wife looked at me when we started our company and she's like, okay, you're finishing your MBA. We're having our first child. Actually, our first child was a month old. Your first child's a month old. She's a stay-at-home mom. I'm like, okay, you're going to start a company and you're going to put whatever money we have in it and you're going to go make this work, right? And I go, yeah. Okay. That's what it was. So it was different.
Hey, you mentioned jockey investing there, which, like I've done some angel stuff in the past, and that's all of those investments have been based on that aspect. But I find it's really difficult to articulate what I think you phrased it as, like those that get it and those that don't. Like, what's your take on that? And like, has that evolved over time and gotten more defined, or is it still more kind of a feeling?
Yes, and the part of it's because of what you guys are doing now. We were talking before we started this. From idea to execution is such a chasm that some people have great ideas and they can execute up to a certain point and they can't execute further. So for me, the jockey now, I want to be further. Like I just put some money into a deal this morning. Former successful founder, already had an exit in the same space, has $1 million ARR. I'm like, there's the jockey now. As opposed to in the old days, like I got an idea. I remember I used to I'm going to sign an NDA because I got an idea. And it's like, no, we're not doing that. So it is evolving, and it's evolving to further down the road, much like what you guys are investing in.
Yeah, and what your kind of blanket is called Habanero Ventures, right? And in that you've got a whole swath of things that you've done over time, but even that has evolved not into just you doing cutting a single check to a single place. You've got some funds that you're a part of. You do some deals with us. Have you thought about that? Was that a diversification play? How did you shift from just some angel checks maybe early on to maybe bigger, maybe different? Like you said, $1 million in ARR. What was that thought process?
So part of it was back in the day, I enjoyed going to angel events or meeting investors. And I'm old now. I'm in my 60s and I don't enjoy that as much anymore. So I want to see the deal flow I wanted to see. So I started investing in, and I really like helping the Arizona-based eco structure for found-up companies to get better. So I've been doing it a long time. I think part of my legacy will be he helped take it from a very small community to something bigger. And so if there's I'm in most of the Arizona-based venture funds, I'm an LP in. Then I found once I got into those that you guys are doing the homework. And so I'll do a side deal right next to it. This deal this morning was I'm in this venture fund. It's Arizona-based fund, and they're going to put some more money into it. I'm like, yeah, I'm in. And so I now know that I'm going to probably see most of my deal flow through people like you. And so that's changed the way that I don't really spend a lot of time. Or if another founder or somebody like you says, hey, Justin, you've sent me a couple people. It's like, this isn't for us because of what we do, but Craig might be a interested player. So I'm really changing the way that I look at how I invest.
Well, that's, kind of goes back to what you opened with there. Like it's the best business and the worst business. I'm curious if this is similar to what you've seen. Frankly, deal flow is, could really be a double-edged sword in terms of you certainly once you've gotten your name out there and folks are aware that you're investing, or I shouldn't even scratch that topic, like regardless of what they know about your thesis, will kind of throw things over the fence, and that can become just a huge time suck, I don't know, I guess I fundamentally know why that is, but like you can be as bold as possible with, this is all that I invest in. Don't send me anything else beyond this. And still that's going to come through. So I have to imagine you see a lot of those deals. Like, what's your approach to it's going to be a problem?
Yeah. I just got off the phone with a guy he's a former dentist. He invests in dental practices. He's out of Minneapolis. I met him and he was like, maybe we should do something. I spent 30 minutes. I'm like, yeah, no. And so I do have one of my companies is a dental, we sell to dental practices. And so I thought maybe I introduced the founders together and then I'm out. But to your point, yeah, I just last week I got ASU's got a whole something that they do with VCs, and one of my buddies said you should meet Craig, and they want me to go join. It's like a $10,000 minimum, and I'm like, I'm not coming to one of your meetings. I'm not.
Yep.
So you're exactly right, Justin. You just see deal flow is a term for I'll just show you everything.
Yeah, I think just being conscious of time, true, said it many times, but is your largest asset, right? And just trying to reserve that asset in any way you can, I find is incredibly difficult, especially in an ecosystem like Arizona, where there still are finite resources. I think capital's kind of become very available to B2B SaaS in a lot of ways, but there's obviously a lot of different verticals and a lot of different business types out there, and when you've got a very finite number of funding options, it just kind of all tends to get thrown in every direction.
Yeah, it's interesting because I don't have a specific niche like dental practices.
Yep.
And now, I'm 64 in a couple of weeks. Now I'm looking at it and going, I can't go with an idea that might take 10 years. I don't have a time horizon anymore. And that's literally, I've been saying this for the last couple of years. Like, I need to invest further down the stream. Like I'm an LP in a fund called Leading Edge, which it's only founders can get into it, and they're super cool, but they're big. But it's like, I want something that's fairly quickly. Now I can see the horizon. And then I think that's a lot of what you're looking for is like, hey, we're not trying to find an idea that maybe 9 years from today is going to hit. It's like, hey, we're just going to take it, blow it up, and sell it. Now, your thesis hasn't paid out yet, right? We haven't had an exit yet, but I like, at least that's the thought that we're trying to do. We're not starting with something else now. And, my son and I started a SaaS software company 4.5 years now. Josh is an advisor for us. It's a lot. It's a lot of work. And,
Yes.
and I'm like, it's for the young. Charlie, my son's 30, and it's for him. And like, I'm out. I'm like, I kind of hung in there for 3.5 years. And I'm like, in December, I said, you're the guy. You need to run this day to day.
Yeah, absolutely. Well, you kind of alluded to something that I think we wanted to talk about in this regardless. So 25 years, a pretty decent horizon. You've seen quite a few macroeconomic trends. And, we keep hearing that there's dry powder on the sidelines, that LPs aren't seeing liquidity. Has there been any correlation between what's going on in the markets and when you've seen liquidity on your deals and exits and things like that? Are there any trends that you can correlate to time and just being in there, or what are you expecting in this environment right now in terms of what your portfolio looks like and the possibility of your horizon?
Yeah, I've been saying for 2 to 3 years, and I would think, let's say I have, at some point, I think I'm the largest owner of small companies in Arizona. I have 70 companies in the portfolio today. So yeah, which is a lot. 9 or 10 are female owned, right? So and I would say 40 of them are Arizona based. And I would tell you that none of them, and I'm on a 2-year kick. When I talk to them, and I'm an advisor to quite a few of them, I'm like, there has to be a path to pass cash flow positive. And I'm getting pushback. People are fighting me on this. No, we're going to raise more money. I'm like, there has to be a path to cash flow. And it's like, unless you're just growing unless it's such good news money where people are so excited about investing with you because that $1 million that you're going to raise is going to go to closing the biggest account you ever did. And it's just amazing to me how many people are treading water right now. It's like, I've had at least 10 calls in the last 3 months that are like, hey, we're still at the same ARR we last year, but let me tell you why it's better, because we've taken this client out, we've replaced it with this client, and we're doing this.
We've learned so much.
Yeah, that's right. That's right. That's exactly right.
I 100% agree. I think whether it's the, optionality in terms of, if we don't hit X, Y, and Z, this is how we're going to foster that liquidity. Maybe that's dialing back some expenses. Maybe that's moving some things around. That benchmark for what is hyper growth or even what is, venture growth these days, it has just continued to increase. It used to be that, like, if you had a deal that was doing 2x year over year, 3x year over year, like that was a hyper growth organization.
Yes.
And people could see that trajectory. Now with this kind of AI wave, and also probably more speaking to the efficiency that it brings within an organization, like talking about 8, 10x growth year over year before some organizations will even get out of bed. And that is not something that we see frequently, right? Like normally you're in that, hopefully you're in that 3 to 5x per year growth trend, but that's just not the case. I guess my question here is like, why do you feel, you said you're getting pushback from founders, why do you feel like that is such a disconnect between what investors like yourself are often saying, like, hey, we've got to have a backup plan here, we've got to have something that is going to keep the lights on, versus what appears to be just kind of frankly a bad stewardship of capital?
We have a couple of investments together where I'm an LP with you, but I'm also a direct investor. And we have a couple of those where they're pushing back, like, we're growing like crazy. We want to keep growing like crazy. We can continue to have $100,000 a month negative cash flow, and we'll just raise more money. And I'm like, you're just putting yourselves at the whim of the marketplace. And I'm, while we want to be entrepreneurs, entrepreneurial also means you got to make great business decisions. And so to me, I'm like, you can negotiate a better deal if you're cash flow positive and you're telling them, I don't need the money. We have one of those right now where, Eli, he's like growing like crazy. He doesn't need the money. And it's like, if I take money, it's going to be for the right reason. And so, that's one that you guys have looked at. I've been in a couple of times with Eli now, and I'm like, this is what I want. So when you look like a founder like that, I don't mind investing with somebody on a second time. And I looked at my deal flow last year, and let's say I did 6 or 7 new deals, but I did 9 deals where I put additional capital into the same as a follow-on. And it was like, most of those were like, this is the reason we're so close now. And so that to me is like, that was too big of a year. I need to back off of that. That was like too much money, out the door.
Well, when you do that follow-on, is it more like you feel there's options, right? Because if you're on that trend towards cash flow positive, to your point, okay, now we have options. It maybe we're not forced into this, I'm burning $100,000. I need this bridge round just to stay afloat. It's my only option, versus I'm at break even. The cash can let me do 1, 2, or 3, and it's actually a bridge to this potential outcome that could, you know what I mean? Like, is it just that? It's that simple? It's like, hey, I have options, so yeah, I'm in. Or no, this is a lifeline.
Well, it's both. You get the founder who's saying this is a lifeline. I'm going to do another round, and then another round, and another round. I have a group out of Flagstaff, -LX, that's on a path to be cash flow positive by the end of the year, and they're going to raise some additional money. And they're raising money because they're just landed Nike, and they've got a couple other big clients. And I'm like, okay, well, that one makes sense. So I added the pro rata share to that round because he did have options. He did. And we had a conversation about it. It's like, well, I cannot raise this. And I'm like, and we talked back and forth. And at the end of the day, I was agnostic to whether he did or not, but he ended up doing it. And I thought, okay, that's good, because he's thought it through, at least, as opposed to just putting himself in a position where he couldn't do that. And I have multiples of people that are still raising money and think they need more money and can't get to cash flow. And even on my own, OneSource, our own software company, I just write a check because we had to grow. Part of this issue is, to your guys' point earlier, Justin, is, and we have to move faster, right? And so we just added we have 3 full-time engineers now, where we had 1 because of speed, because of AI. You just can't sit around that anymore. If you can't see the horizon, I think you're in trouble these days.
Craig, you've seen a lot of deals. You've obviously talked to a lot of founders. What are some of your, I guess, immediate red flags, and some of the ones that you've seen them develop over time when you're making, if you're evaluating a deal, and then some of the things you've seen, like if they're asking you to do a follow-on and whatnot, where you're just going to step away?
Yeah. Is the founder putting any money in the deal? Is the founder taking a salary? Is the founder credit cards? Is this their deal? Is the founder got, if I'm asking the founder, I want to know, is this, I literally had a founder's like, yeah, this is another deal I'm working on. And I'm like, no, I'm investing in you to go make this happen. You have to be 100% plus invested in this. And so on the founder side, that's a key thing for me. And I do get these guys coming. I'm only taking 120,000 a year, a salary, and I'm like, what? Well, I used to make 250, and now I'm only taking 120. I'm like, you should be taking nothing. One, and if to start the company, and two, maybe 60 grand. I don't know,
Right.
lifestyle, whatever. So that's
stay hungry, right?
yeah. Well, it just shows commitment.
It's austerity as well. Like how do you approach the business? And that's become something that has just been a big topic for me as of late, because the trend here, if folks aren't picking up on it, is like in the last 2-3 years there's been a lot of bridge and follow-on capital that most businesses are forced to kind of go down that road, to the point earlier on. And it's just, I think your point on, like, is the founder putting up any capital in that round? Where is that money gone? If we really learn lessons, or if we just tried to do some random thing, and now the plan is to do another random thing. And it always seems like the good versus bad there for me seems to be when a founder's, coming to the board, the investors, cap stack, and say, like, these are the things that we're going to do with this. And it turns out like it's this complete needle thread. And like, it's almost like this utopian situation. And, kind of to multiple points we've been talking about, like, that is not what you can rely on. You have to have built in some of that, both austerity and optionality.
I will give you one other thing, because I've listened to a number of your podcasts. One of the things that I've learned, I've been doing this for a long time, and Justin, you guys, and Josh, you guys started the company, Sean. It is fucking hard to make a business go. And we talk about this stuff like, hey, we're just going to take this ARR million to a $2 million ARR. And I'm like, okay, well, that to me, now that we've done our SaaS software company, and Josh and I have had this conversation like 10 times. When I started my real estate business, it was me. I'm going out there and going, hey, I want to represent you, and I'm going to take care of you. And I could sell me. Then I start a SaaS software company. It's like, hey, I'm going to do this. And they go, okay, great. We want it now. Show me the software. And then they go, well, that's not very good. And I'm like, no, but I'm really good. And they're like, well, I don't give a shit. And I'm just telling you that one of the things that I think we miss as venture investors is how incredibly hard it is. Like, to your point, there is, and I say this all the time, you're talking about threading the needle. There is 1,000 ways that we will fuck up a deal, and there's maybe one or two that's going to hit right. And so if you miss something big, then it's over. And so we play that risk game, but I am more acute to it now after having started OneSource, and Josh has watched us try and figure out our deal. We figured out how to sell because Josh and I can sell. Now we have to figure out churn, because we've never done that before. We're like, take the rear view mirror and I throw it off, and I'm like driving down the road, and then I've got guys trying to pick up the pieces behind us.
You're really getting both views here, right? Like you're truly running and operating within a startup, and then you're investing in them as well. And I have to say this is obviously like my very biased opinion, because this is our approach. My approach is I find it incredibly difficult, even sitting on boards with other investors, when you don't have that operator knowledge. And you can just tell some of that advice, right? And I've seen that advice manifest in terms of, let's pump more money into the business, or, let's what are we doing about AI? You know what I mean? Like, just crazy off the wall thoughts that just, frankly, I don't think are productive inside of a board meeting to get people on tangents and so on. How, each situation has informed one another. Like, have you changed any of your outlooks and your thought processes having operated in startups?
Yes. I'm a lot less of an excited about investing in companies that aren't figured out and growing like crazy. So, I mean, it's incredibly hard. I was just thinking, 20 years ago, I invested. My buddy was a baseball player, and he invested Nutty Buddy, which is a cup.
Nutty Buddy.
We make protective cups for baseball players. 20 years. So he had this
Great
idea.
name, by the way.
He has a great name. He had a patent. I put $250,000. He didn't have a penny. I literally haven't gotten my $250,000 out, and the company's still around, right? We're still making money on it. And it's a great company. And it's like idea to execution is so difficult to do. And so I've become more cognizant of what these founders have to do. And, it's part of it is they don't know, and it's okay for them not to know, but I don't need to be the investor to kind of when they go through that anymore. And I have some right now where guys are swearing to me that their company's worth 10 million. They don't have one customer. I'm like, it's not worth 10 million. It is.
Yeah.
And it's not.
At some point, you got to run a business.
That's right. That's exactly right. And I think that's one of the things I've really found is running a business is hard. Finding people is hard. Selling is hard. Churn is hard. Technical, everybody says you got to have an AI piece now. That's easy to say. Then you sit down with your technical guys, go, well, you don't even have the foundation piece. Now you have to build that before you can add the AI overlay on it. I'm like,
well, that's what I find so interesting about working with your team at OneSource. They are by definition grinders. Like I've never seen a group that grinds the way they do, regardless of what they know, right? They may know nothing, but they're just going to go and do it. So they are very good at execution. And it's funny because, now it's a monthly cadence. It used to be weekly, and, we just get together monthly now. But every month it's like I invented fire, because the month prior they turned over a new rock that they hadn't seen before. And I'm like, guess what? I'm like, oh yeah, well now here's what you're going to see in the next month. And then I come and they're like, oh shit. They just like lose their mind every single time. But what I credit them for is the execution to just like go and do and try. They're not afraid to fail, and they document stuff. And we talked about this. We had a podcast earlier about how people don't document and create this shared knowledge repository. That group, man, they will document, go right or wrong. They give it a go.
And when you think about what people, sorry, really quick note, like you think about what people index on in the hiring process, and it's all the former. It's do you know the space? Do you do you know this buyer? Do you have any referrals you can bring in immediately? And it's never on that operational process, which is just totally out of whack.
I can't tell you how many founders have said, we're going to raise money, we're going to go hire a vice president. You guys hear this all the time, vice president of sales, and then
every time,
and then they go out and spend 100, and then the next year they need another 100 grand or 200 grand because we're going to do the same thing. Every single person that's full time with us at OneSource started out as an intern, and it's our proving ground, it's our minor leagues, and so these guys come in and they do it. And to Josh's point, we bring Josh in because he's been there, done that. But part of it is, Josh has done it on the consulting side, right? You guys have, you're selling, but you're selling a service. This is a whole different ball game. Josh has never sat there and sold a SaaS product. Trust me, you leave and try and go, that'll never work. It worked over, but it's not going to work here. And so it's like, you're like, what are we looking for now? I'm looking for somebody who's got it, who's really figured it out, and who's on a path, a trajectory. Trying to.
Yeah.
And I have sold SaaS, so don't give me that bullshit.
Josh is feeling slight.
Yeah. Oh, yeah.
I could see him fuming over there, just starting smoke coming out of his ears.
I'll give Josh some credit there. Like, we've injected Josh into a lot of businesses now at this point, and in complete, adds inverse to every thought that the founder has in terms of like, I need someone with deep knowledge, just not even just a vertical, but like healthcare, who sold, billing platforms to, women 45 to 55. And it's like, you don't need any of that. Like, you just need good foundational, frankly, sales skills. And like, again, I'll toot his horn a bit. Like, he's come in there with the same foundational skills and been able to create a path to success there.
Well, the other thing that you guys recognize, Josh is a unicorn. I mean, when you go in the marketplace, there's a lot of B players.
And they sold the one person that matters.
That's right.
They say it all the time. They sold the person that hired them. Yeah. And that's the only sale that they're going to have for the rest of the time with that company.
That's good.
I want to touch on something you said before, just because I think it's important. But to your point, like there is most every investment that we make, they want to start off and hire someone who's a CRO or a VP of sales, right? And you can't go top down on that because you got to have someone actually doing the thing, right? And you got to be hungry for it. You can't take a 200K salary, with a 400K OTE as being like, the founding sales rep. And so I think we've seen it in almost every single investment that we've made where they have a false start on the first person they hire because they're either too senior or to Josh or to Justin's point, like they're too much in that space where they've done it all very particularly, you know, in a very narrow kind of buyer persona, and then they can't expand that way. And so I think critically it's harder for founders to be able to understand that, you know, once it goes from founder-led sales to that first person, they need to find someone who's hungry, who's probably going to take a little bit of half step, if not a step above where they were before, but who's able to still get dirty and can kind of create that process and then document.
It's one of the critical steps that people miss from becoming an idea to a real business. That founder-led sale to a sales team doing it, me stepping out. It was the best day. It was literally the best day of OneSource when Charlie said, "Hey, we need to get you to stop doing demos because you're just selling you." And the guys were way better than me. And I was like, he thought I'd be mad. I was like, that's exactly what I wanted to hear. I wanted to hear they're way beyond me. Josh is giving them fire every month. And so it is really, and it's critically hard. It's really interesting. I've got a company right now that I'm a big investor. I mean, this is a big investment for me. And the CEO can't, and he's a tech guy, thinks he can sell. He can't, but he's trying to sell and he thinks he's selling, but he's not. And it's like, we need a sales guy. And so, you know, Josh knows who I'm talking about. And it's super difficult to have these conversations. And I have a position of influence and I can't get him to do it. And it's like, anyway.
Yeah, I think the funny thing is everyone, to Sean's point, like everyone tries to do this big, I think, oh, okay, I could just offload this thing I don't want to do if I bring in this person with all this experience and this book, right? Whereas you went the complete opposite approach. You took 5 interns from Grand Canyon University and mentored them. They think you're God, by the way.
I'm done with them. I'm going over to do a presentation. I go over twice a month and do what I call a moment of genius. Like I'm coaching them up still today.
That's what I'm saying. But they're so great now. They're so great. They execute. Like you gave them time. You gave them mentorship. Like you showed them this is what good looks like. And they just go. They eat it up and they go.
Everybody. Not only that, like you have a, like what you call it there? A moment of genius.
Yeah.
Moment of genius.
Every now and then I have a moment of genius.
You have a construct for that. You know what I mean? Like it's a program that's been designed specifically to, I'd say at the high level, indoctrinate, and at the lowest levels, provide operational, you know, inspiration and so on. So like even having that and thinking like, I need to bring this talent from wherever it's starting to the next inflection point is something that's really missing out there. And I think a huge opportunity.
Well, as a founder, they don't think about this. I mean, Josh comes over. You should come over, Justin, Sean. You're welcome. The environment over there is exactly what you want. I mean, when you walk in, you hear these guys on the phone, and it's going. Like we're doing. We have another 7 callers, and it feels like a startup company really making good. And then I go to these other places, and they're like, "Yeah, I have one company. They're like, yeah, my salespeople, they need to make 10 calls a week." And I'm like, that's Monday morning by 10 a.m. You know,
what are Brock's numbers right now? Like 500 a week or something?
Yeah,
like
yeah.
that.
We're dials, you know, because we have a speed dialer. But these guys we've done 200,000 calls in the last year. I mean, we're out there. And so,
I mean, that's a cultural thing, right? I mean, you built that from the ground up, right? And then anyone else that comes into there, they either fit into it or they don't, you know? And so you can't just
and it depends on the business. It depends on your business, right? If you're selling to somebody like small onesie twos, that's great. But if you're selling to, there's customers, there's a whole different approach. And you guys have done that from your previous days. And I understand that, and there has to be a different, but the solution, I think what we're saying here isn't just a hire and go away.
Right. So with this, yeah, agreed. You know, like the input is what it is, but that input is palpable. Yeah. And then, you know, wherever you walk into, I think you're going to see people like, are they working hard or are they not? With all this perspective that we've talked about, primarily from the startup side and the kind of deal flow side, but like when you talk to other folks who are either an existing LP in whatever capacity or considering, you know, kind of taking that next jump to becoming an investor, like what advice would you, you know, impart upon them at this point?
If you're thinking about getting into this business, be an LP in a fund or in a, like in special use like you guys do.
SPV.
Don't go SPV. Do not go directly into the investment unless you're committed. Because I like to my point earlier on, is like my first 10 deals, first 7 went under. The 8th one was a company called Capital Title, and Capital Title, I think I put $100,000 in and I got a $700,000 check. And I was like, okay, now this is the game, right? So then the game was I got to do 10 and maybe 1 hits. So then my idea was, okay, I got to get 20 or 30. And then I okay, now I'm at 140 of these over the last 25 years and I've got enough, but now my momentum starts. But don't get into this game if you're going to do 1 or 2. You got to get in this game with 10. And the idea is to let you guys do the due diligence. And if you want to do an add-on later on, great. We just added on. So I have a company out of Tucson, Pix Health. And, I was original investor in Arizona Founders Fund. And Cindy Jordan, Romy, who runs the fund, said everybody says there's only one Michael, there's only one Jordan, there's really 2. Because he loves Cindy. And I went down there, I drove down to meet her, and she's a total badass. And so I just put my fourth investment, maybe 5th in Pix, and they're now at 60 million ARR. And I put more and more in there. A Tucson-based company doing 60 million run rate this year, like in healthcare. It's impressive because she's the reason. And so now I would just say to other people, find somebody like we can, and then slowly get into it. But don't go do just your friends who's starting a company and has an idea like Nutty Buddy was. Bad idea. I just have to,
bad idea.
Yeah, 20 years later, I now own 70% of that company.
It's still strapped with Nutty Buddy.
Yeah, exactly. I'm making some cash flow now, though.
Yeah, but I think that, frankly, all the same advice applies here, right? Like you can't, there's no easy button. I think the thing that seems easy is never such. To your point earlier, like the losses always come quicker than the wins. And like your brother-in-law's software company that, he's pitched you all this great information probably is not the best place. Could be. I think you really have to commit and go in. And to your point, like if you're going to do the diligence, you got to really think about where those deal sources are coming from and really go deep on what you care about in those organizations, or partner with someone that you've also done due diligence on and can trust that they're looking at the right things.
Yeah, I put a note in here on this is like, I trust you guys in your due diligence. I mean, I think the last deal came in, you guys sent it out, and Mike, I just replied, yeah, I'm in. Didn't do anything on it because you have to learn to trust. And I learned that from Robert Kiyosaki. Like Robert came to me, on the real estate side, Robert and I are partners, and Robert and Kim and I have been investing together for 30 years. And he came to me like 15 years ago and he says, Craig, I'm not doing any deals with anybody I don't know anymore. And I thought that was a great thing. And so I'm like, I'm doing deals with guys that I know and trust. I know that you guys are going to do it. So I trust your due diligence. And so to me, one of the things, if you're talking about getting into this, is to find people that you trust. And it has to be somebody who's got more deal flow than you, because you're not going to be able to see that. And I still can't, after 140 deals, I'm not as good as you guys are at my due diligence. I'm simply not. I have another business that I run. This isn't my full-time gig.
Well, Craig, it's been awesome to have you as always. The insights are top notch. Always bringing looks like you're making cold calls right after this. So get your 150 dials in.
That's great. I love you guys. I love what you guys are doing. I love the podcast. The idea, it's easy flow. And thanks for having me on it. It's been with 3 years. It's your 36th. I'm glad to know I'm in your top 50. I didn't make your top 20, top 10, but your top 50. I should feel good about that.
You really should.
We're waiting until we got into a flow,
That's right.
Yeah.
Exactly. We want to have the long-winded intros.
Really savor a lack of preparation for you. All right. Well, for those of you listening to the first time, please like and subscribe if you can. Remember, the go-to-market cheat code book is still available on Amazon. We'd love for you to pick up a copy. It is a national bestseller, so it's definitely worth a read. Craig, I think, distributed to his entire portfolio, so we appreciate that. As always, and Craig, thank you for joining the show. It was great to have you. Great to see you.
Appreciate it. Thank you for having me on.
Sean, This has been another episode of The Cheat Code and Friends.